Welcome to Cybersecurity Where You Are, the Center for Internet Security's podcast. I'm Sean Atkinson, CISO at CIS.
And I'm Tony Sager, Senior Vice President and Chief Evangelist at CIS. Cybersecurity affects us all, whether we're online at home, managing a company, supporting clients, or running a state or local government.
So join us on Wednesdays as we discuss trends and threats, explore security best practices, and interview experts in the industry.
Together, we'll clarify these issues, creating confidence in the connected world.
Hello and welcome to the show Cybersecurity Where You Are. I'm Sean Atkinson, CISO here at the Center for Internet Security. Joined today by Tyler and Daniel, and we're going to be reviewing the foundations of actuarial science in cyber risk. But before we get into that, Tyler, would you mind giving us a brief introduction to yourself and your work?
Sure. Yeah, my name's Tyler Moore. I'm a professor at the University of Tulsa, and I was trained as a computer scientist, but do research in security, economics, cybercrime measurement, and the like.
Fantastic. And Daniel?
Yeah, so similar to Tyler, I actually worked under him when I was a research visitor during my PhD, so similar topics. I'm now a lecturer at the University of Edinburgh, and I have a second role at Coalition, who are a cyber insurance company, so I've seen some of these ideas in practice.
Fantastic. So let's jump in. So Tyler, now let's talk a little bit about actuarial science and how it really fits into the traditional approach of risk modeling.
Sure. So, actuarial science attempts to model uncertainty over insurable loss events so that you can set fair premiums that will cover those expected losses. So it's using probability and statistics to measure and model the risks on the data that you collect. You could say it's one of the original data-driven sciences because it's focused on these highly practical problems with serious financial implications if they screw it up, right? So originally it was how do you provide life insurance? And so they computed mortality tables based on age and these other observable characteristics, dating back over 300 years ago. But since it's been applied to all kinds of business and personal risk, from car and home insurance to, liability exposure for firms.
And in some of your work, we've been looking at the applications of those types of models, but cyber risk is particularly challenging in this space to quantify and as compared to other types of risk. Would you agree?
Yeah, historically so, although I think that's getting a bit better compared to how it used to be. Data historically is really hard to come by, at least the kinds of data that the actuaries are going to want. So, in its simplest form, risk is the product of likelihood and impact, right? So that's the data we need. We need data on likelihood, data and on the losses that could occur, right? So, in cyber, it can be difficult to get either of those things, actually, right? If you're an individual firm, you may experience an attack only one time or not at all. And so if all you have is your own view of the world, it can be really hard to estimate what that a priori probability is. And losses themselves are very hard, right? Because in some areas, like if you experience a ransomware attack or there's a financial fraud, that directly translates to dollars, but so many cyber threats don't directly translate to dollars. And that's where the challenge comes from.
Yeah, we've got to get creative with the data, as it were.
Yeah.
Now, the other thing, there's different types of data, right, that's used in these actuarial models. You went through a few here, but the cyber domain, one of the things, that I see, and we all need the data in order to build the model necessarily, or make it as accurately as possible, or try to get to that level of accuracy. But Tyler, when I think about it too, is we don't always have the right reporting. Ransomware attacks go unknown and you're kept very clandestine and not publicly recognized and things like that. That affects data collection in some cases, but also the development of models over time. Is that seen as a challenge? And how do we attempt to utilize the data that we do have in the cyber domain?
Yeah, so I think it's a huge challenge societally. I think from the insurer's perspective, it's not as much of a challenge for them privately because they are focused on modeling just those cyber risks that are insurable, right? And so if insurers of a decent size will have enough claims data that comes in that they can actually do something with it. Now, the insurance market itself is highly competitive, and so but it's dominated by a few large players, and the larger players do have enough data for themselves, but there are some of the smaller players who are going to have less data available for sure. But I think in general, with when you think about the data that is available to insurers, it's much better than typically what individual firms are going to have on the overall likelihood of particular threats happening. Now, there are other areas in which the firms actually know a lot more because they know about themselves more, right? So they have dedicated security teams who have more awareness of what's coming into their organization. So if you talk to people in the insurance industry, they actually would like more data than they currently have.
And I would say, like, an interesting perspective is how this has changed over time. Like Tyler mentioned, different insurers have different positions. Maybe 10 or 15 years ago, there was essentially cyber insurance was bought by a tiny slither of the market. So they just didn't have historical loss data. So what they started to do was they started to think, can we look to other sources? Can we look to public data breach notifications that have been announced because of mandatory data breach notification laws? And what they discovered there is it's actually quite difficult to model with that kind of data because you don't know the population from which it's drawn. You can't just model at the level of the entire economy because maybe there's a kind of reporting bias. This is particularly true for like modeling fraud and business interruption incidents because there's no mandatory kind of obligation to report those publicly. So these are some of the challenges that insurers face. And then as Tyler points out, over time, insurers have started to have internal claims data that helps. One challenge there, and I think it speaks to a challenge in modeling cyber risk, is there are kind of these shifts over time, and they're almost like paradigm shifts, whereas before 2017, a cyber incident manifested as liability costs, maybe notification costs. Afterwards, you started to get business interruption, cyber extortion, really driving the risk. And as threat actors change their behavior, it kind of calls into doubt all of the prior modeling because you're essentially modeling a different peril.
Well, exactly. And the velocity in which that changes also is an issue, right? In terms of building the model, I just created a perfect model. No, now it's a different attack vector. Oh, okay, back to the drawing table. In some cases, Tyler, would you agree?
Oh, I think that's absolutely right. I mean, I think there's the potential for attacker evolution is much more rapid than other spaces. You compare it to other areas in which I would say actuaries kind of have a grip on things like auto insurance. There it's much more predictable. You have data on people's driving habits, how much you drive, and you have accidents occur. They do have to update their models, but that's just because it gets more and more expensive to fix to repair an accident. So I think that compared to that, we have a lot more change in our space. But I will say, the even within this compressed time frame, the cyber insurers who have been involved have shown some ability to adapt. Like I think at a more rapid rate than I probably would have predicted that they could have.
I would say it really depends on the kind of thing you're modeling. Like, for instance, one constant is that law firms are really high exposure for fraud, and that's because the business model is based around sending payment requests just constantly. So attackers know if you compromise a lawyer's inbox, you can just interject yourself and funnel funds to the criminal. So law firms will always be high risk. I guess what's difficult is attackers will adopt different methods to basically perpetuate those frauds. So the actual loss controls might change, even though the industry class remains higher risk.
Exactly. Now, Daniel, as we go down this path, though, one of the things that is used in this space is loss distribution modeling. And does that change, or is there a different perspective when thinking contextually about cyber incidents compared to other forms of loss distribution modeling techniques?
Yeah, so I would say it really depends on the kind of loss. Like in insurance, we often speak about kind of severity or heavy-tailed losses. So for instance, Ransomware tends to have a heavier tail because if you have an organization with particularly poor resilience, occasionally they can have outages for weeks, maybe even months. There's a recent example of Jaguar Land Rover in the UK who had months of kind of disruption knocked off. Thankfully, they were trying to buy a cyber insurance policy and for whatever reason chose not to bind. So that didn't kind of impact the industry.
Yep.
But then if you looked at other types of losses, they tend to be much kind of less heavy-tailed. So for instance, business email compromises almost universally show up as like a loss of around $50,000 because there's only so much harm that can result. Maybe it's a particularly dense email inbox and you have to do data mining. But a business email compromise will never be a kind of 30, 40, $50 million loss.
Yeah. Well, it's interesting, though, how those are applied. And again, I think there's an element of threat intelligence ingestion to look at how the model necessarily is currently being built, potential future attack capability, the type of attacker, and really the underlying motivation in some cases. As you mentioned, that there's a differentiation in that space. So when we look at cyber incident, I think we probably could contextualize it and look at loss distribution from nation state attacks, cybercrime, these types of parenthetics. That may, I don't know if it helps or confuses the situation in terms of applying these types of techniques, especially, like me internally as a CISO trying to think of, I want to get to quantification, but I don't necessarily want to have, I don't want to go through the actuarial exams in order to be able to do it, with statistics, the probability, and all of those, the SOAs and things like that. But yet it feels like there's sort of a barrier in that space. So when you look at it, Daniel, there's some practical ways where we can integrate actuarial models with frameworks that, I'm used to, like the factor analysis of information risk. Have we started to see any of those types of integrations or an ability to integrate, or are they speaking pretty much two different types of languages?
No, so I can start first with the question of the links between
Sure.
actuarial science and FAIR, because I think that's easier to answer. And then I can answer separately how, CISOs might use actuarial information. So in terms of the link, I think both communities think about the risk similarly. Tyler mentioned this distinction between severity and impact. All actuaries, when they're building a model, will start with predicting frequency because that's typically easier to do, and then they'll build a separate model for severity. So that kind of broad view of the world is shared. I think where the differences come in is actuaries are somehow more agnostic than FAIR practitioners. So in FAIR, you try to divide frequency into, on the one hand, threat, and on the other hand, vulnerability. And actuaries just don't need that structured view of the world. Like I mentioned law firms, they see law firms are much higher risk. They don't really care if that's because they're targeted more often by attackers or because they're not investing in controls. Actuaries just say law firms are this much higher risk in general. So they don't, try to kind of classify things using expert judgment in the same way. And then when it comes to the severity part, I would say a really interesting thing. Frequency is much easier to predict. Actuaries believe they have much more reliable models, whereas severity is seen as much harder to predict. There's much more uncertainty in their loss models. I think that's partly because there is just fundamentally more information in a severity curve. Whereas frequency is just yes, no, do you suffer an incident? Severity is a continuous distribution. I think the other side is we've not really got to quantifying things like resilience that really impact the severity curve. So that means there's a lot more kind of unpredictable variance in it.
Yeah. And how necessarily resilience is applied as well from different organizations' perspectives. Because I've seen, and as we look at actuarial models supporting cyber insurance underwriting and pricing, it's also interesting to see their approach to the resiliency organizations have. Just in, as a use case, we've seen organizations look at the CIS controls as being a requirement as part of that resilience capability to then ultimately have an opportunity for cyber insurance in that space. But anyway, so Daniel, how are the actuarial models then supporting cyber insurance and underwriting and pricing?
So, in terms of supporting underwriting and pricing, the way I see it is the actual actuarial model is like the global view of risk. You say, for instance, like there's data showing organizations with Google email, Google Workspace, are about 30% less likely to suffer a funds transfer fraud or business email compromise. And this has been shown across multiple insurers. Whereas underwriting is slightly different. So pricing takes this global view and you talk about averages across big groups. Underwriters are more likely to say, oh, well, this specific organization I've spoke to, for instance, the chief finance officer, and I know he's militant about financial controls. So I know that that organization is, although they're in healthcare, let's say, which is typically higher risk, they're less likely to suffer an incident than the typical kind of healthcare organization. So the actuarial model is providing global knowledge, and underwriters are able to capture this local knowledge. The second aspect, which I think is more commercial, is if you think about as an underwriter, you're also trying to not price the risk fairly. I mean, ideally they are, but what they're also trying to do is extract the most money. So there's no point selling a policy at 50% of the value as compared to the nearest competitor. So a lot of what underwriters do is essentially price discrimination. So they try to look across the market, get competitive intel, and make sure the premium kind of captures as much value as possible.
Wonderful, wonderful. We're going to take a quick break, but when we come back, we're talking case studies, breach scenarios, misconceptions, and the role in evolving the cyber risk landscape. So we'll be right back. Zero-day attacks involve vulnerabilities with no fix. They lurk in the shadows without your knowledge, getting up to no good. This doesn't bode well for your endpoint security. With zero-day threats hidden in plain sight, most MDR solutions simply aren't up to the task. You need something different. Turn on the lights with CIS MDR. Available exclusively to paid members of the MSI SAC, CIS's MDR delivers more than alerts. Delivers action by transforming raw telemetry into clear prescriptive steps. CIS does this using behavioral analysis, helping you stay protected against zero-day attacks and other threats you don't know about beforehand. Especially coupled with the 24/7/365 CIS SOC as your full-time cyber defense partner. And let's not forget CIS MDR's hosting options in the GovCloud and commercial cloud, supporting your compliance needs. Fully managed and monitored, flexible hosting, CIS MDR's got your back. So get started today by visiting cisecurity.org. So Tyler, we come into now and we're conceptualizing all of this capability. Is there a case study that you know of where actuarial modeling actually improved cyber risk management?
Well, what I would point to is how the cyber insurance industry has reacted to ransomware's rise, right? So when ransomware came on the scene, it actually caught the cyber insurance industry completely by surprise. They weren't modeling for it at all, right? So they were competing on price at that point to win market share. And this is back in the simpler days of when they mostly just had to cover these relatively lower costs that resulted from data breaches. And then all of a sudden, all these claims came in that none of the actual models predicted. So maybe this is a strange one to say as a good case study, but I think what it shows is they reacted very well. So there were big losses initially, but there was a fairly rapid adaptation to the situation, right? So and they focused really on two main areas. One was there was a lot of effort placed on sort of what you do after an incident to minimize the ultimate losses, right? So a whole suite of services has emerged, that the insurers themselves manage, DFIR, legal advice, even ransom negotiators. So by reducing this ultimate loss, this kept the premiums from rising even more, and also then fed data back into the models, right? So we see this nice reaction that's sort of rational and a rational response that the insurance industry provides. But they didn't, initially it was very much focused on dealing with the post-incident cost, but then it shifted to identifying what behaviors are sort of risky and Daniel gave some nice examples earlier on. But then they applied pressure on policyholders to change, and that's been a multi-year process that's ongoing, right? And so we've seen this, and that there have been a push for wider adoption of multi-factor authentication at the enterprise level, but also sort of improved asset identification through and management, bolstered by these outside-in scans that they started doing of networks. If you could find that you're running, you've got a global print server that's running something outdated, that's gonna ding you. I can give an example from my own university. So, for a very long time, faculty were automatically granted local admin on their university provided devices automatically. And I loved that, actually. We had IT stayed out of our hair. But then, came time to re-up our cyber insurance policy. They said, look, they're not going to renew us unless we actually have a policy with separate accounts for local admin. And that finally caused our IT to overcome their fear of confronting the faculty and changing the policy in a way. And so I think behind the scenes, time and again, lots of interventions and that are sort of being nudged along in response to the very real losses that they were experiencing trying to manage.
I would add to that an interesting perspective. Like Tyler is mentioning, basically when the insurer drags the CISO against their will almost to implement a control. I think there are also examples where the CISO and the insurer are on the same page. Like something I've looked at is Coalition has found that certain VPNs, Cisco ASA device, for instance, is associated with a 5 times likelihood of suffering a cyber incident. So if you were a CISO who knew this kind of legacy device that was acquired before you even joined the organization was installed in your network, that would be evidence you could take to your board and say, we really need to migrate away from this thing. Another area is, for instance, premium discounts for certain controls. Potentially, it could be used to justify procuring a new tool. So that's where, I guess, insurers and CISOs can be on the same side, in addition to Tyler's examples.
Yes. Yeah, not dragging and screaming, but yes, been dragged. But
I think they like the excuse. I mean, I think it's a cudgel, right?
Yes.
I think I'm not at all convinced that they were upset that they had to tell us that this was the change.
Right, exactly. We get some control back, and they can stop installing all of this bloatware on these machines. Yeah, no, 100%.
Insurers speak the language of finance, which many CISOs struggle to do. So it helps in that respect.
It does. And I think, you mentioned that, and it's one of the things that I've seen, and it's what drew me to the work of Tyler's, was the economics piece, was that translation. I was having a very hard time trying to translate between, here's the risk I see, and I think one of the examples you would use with data loss prevention, here's with and without, and being able to provide that in terms of what we were seeing, the value of the underlying asset with respect to our data. Translating that had a way more positive effect than me just, complaining and just saying, look, we need to do this data loss prevention thing because it's the right thing to do. And I think in a lot of cases, Tyler, I lean very much towards what I call the compliance hammer, and which is, I could tell you, right, I could go to the finance and say, we need this. I get an external entity who's coming to assess and audit. They say it, oh, we've got to get this done as soon as possible. I've been saying this for 2 years. Well, they said it. Oh, okay. So then I'll use the compliance hammer, and then we can get it done. But I find that discussion, that translation, and these elements very very interesting. Sorry, Tyler.
Well, there's only so many times you can use that hammer, right? I think, and I think the point is that to the extent that you can provide different arguments, and I think translation into financial language through risk here really can help a lot, right? So there's always going to be times where you have to break glass, pull out the hammer, but just don't go there as your number one move.
Yes, that's right, exactly. The boy who cried wolf, right? It is going to be, here we go again. It's Sean's here with another request, and he's become a rubber mallet, and I get then hit with it as well. Anyway, yes. Now, one of the other techniques potentially, Daniel, is simulating breach scenarios. How can, from an actuarial perspective, that be used to provide, well, insights, but offer CISOs either information to use to, one, understand the underlying threat environment, or two, understand really that loss frequency potentially? How are those used? Is that a technique that you've seen?
Yeah, so I think the core problem here is cyber risk is probabilistic, and we as maybe academics can conceptualize what it means that your risk is parameterized by a certain loss distribution, but it's hard to communicate that. So what a lot of insurers and brokers do is they provide these kind of financial risk calculators where they take a probability distribution that you need maybe a PhD to understand, and they instead translate it into these basic things like what is your worst case 1 in 10 year loss for a particular type of loss? What is the worst case for 1 in 50 years, 1 in 100 years? And those figures, I guess, are what you can take to a board and say, right now, if we don't make any investments, our worst case in the next 10 years is we lose $20 million to a ransomware event. And you can then use a control, like let's say the control you want to invest in, to say, but if we invest in this control, we can reduce it a certain amount. I think the actual loss distribution is reasonably sound from an actuarial perspective. It's a little bit difficult to quantify the differences across organizations, but on average, a law firm of a certain size does have a certain distribution. I think what gets a lot trickier and shakier, although it helps the CISOs, is being able to say this control reduces risk by this amount. I think that's what we're really struggling with as a community.
Because I would say that's where the data is just weakest, right? So they're good at modeling, the loss probabilities. Severity is a little harder, but still okay. Really seeing like what individual controls and defenses had the impact they have on the loss distribution. It's better than it was, which was there's non-existent, but it's still pretty thin. So I think part of the reason is just that you can't disentangle all of that, right? I mean, the point is that you're adopting potentially hundreds of controls simultaneously, and it just doesn't neatly fit on to the available data on losses to sort of directly tie out cause and effect there. So that's always going to be a challenge, and yet the problem that the CISO faces that they need to go to the board for this one control and see what its additive impact is. And so we can give you a pretty good answer, but it's not not 100%.
Exactly.
I think it's interesting to zoom in why it's difficult and the different perspectives on it. One is, as Tyler points out, there's like a million different ways you can configure 100 different security controls. So maybe that diversity means that if you just model this top level variable, like do you have backups, do you have MDR, you don't get any predictive power, because in reality, every organization manages that control differently. I think another more skeptical perspective, which I'm interested in, is, I guess, kind of through the cyber insurance industry, there's not really much evidence that the kind of InfoSec controls you see advertised at conferences actually reduce risk. And I think at a certain point, you kind of come round to maybe the more skeptical view that maybe they don't work as well as some of the marketing teams expect that they do. It's not the case that if you adopt one of these controls, your cyber insurance premium falls by 90%. At best, for certain controls like MDR, you can get a 10 to 15% discount. But I think that speaks to kind of the gap between what marketing departments want you to believe their products do and what the data shows that they do.
But this is the whole promise of an actuarial approach, right? Is that we're drowning in a world of vendors with their pitches and never-ending controls, and people are making those selections not based upon risk reduction. And what the insurance approach provides a nice antidote to that, which is just don't care about all of the stuff. Let's just see what things actually seem to matter. And so I think, where the real question is and the tension is going to be is like, whose approach is going to win out? Like over time, the technology vendors have sort of won out. But I think increasingly, as the insurance industry gets more mature and involved in this space, I think they could have the winning argument, right? And the reality is that you're going to need a bit of both, right? I mean, technology innovations can really drive things, but you can't just avoid any kind of empirical validation of whether or not the products work, which is where we've been for a generation or more in cybersecurity.
Oh, absolutely, absolutely. You walk the floor at RSA. I mean, that just tells you everything.
Yeah.
You know, if it's not AI enabled, it's not helping, right?
I think this
I mean, that
podcast
puts.
is AI enabled, right? No, it's not.
Oh dear, that's good. Well, the other to your point, Daniel, as well, and Tyler, is what I call that is when you go through this process, I call it demo land, and everything's perfect in demo land. This is going to solve this problem. You're doing all of this, and everything works. And then when you come out of demo land and you actually try and apply it, it doesn't quite look the same. In fact, it doesn't look anything like what has been represented necessarily, because it's not demo land. This is the real world, and very difficult to because I've seen, I mean, you just see it all the time, is these promises, as it were. And to your point, with no empirical evidence whatsoever, not even applying it to your environment, just here's this environment, here's how we protect it. It's good. It should be good for you. It's just false promises, and we can't move forward continuing to do that as an industry, because it's not benefiting anybody. I mean, just continuously adding these elements of controls. And then you even get into now where it's the cross controls is where, well, we do the complementary same as this other company because we're adding, we're procuring all of this capability. We just keep adding and adding functionality. And it works. Sometimes it integrates, sometimes it doesn't. And, oh, well, you still have it. It's a feature. And you have to pay an extra license for it too, just to get the logs out of it, so you actually have data to do anything. Well, that's extra, right? We can't just give you the data because you've installed this product in your environment. So we keep going down this path, and it's I don't know that I see an end to it, Tyler, Daniel, but we've got to bring some realization, I think, to the industry, utilizing these types of techniques we've been talking about today to make judicious decisions in that area. Tyler, would you agree? Any thoughts there?
Yeah, I mean, I think what I would say is, for more on that, go to the archives of your podcast when we talked last time about economics and some of the market failures that are present. I mean, that's the fundamental challenge. I mean, I think you can either look at that and throw your hands up, but I think that the nice thing about our conversation today is that rather than throw your hands up, what we actually see is the insurance industry making the best of what's available, right? And so I think that is a reason for optimism. I just think we have to be realistic in what we expect them to be able to help with.
Exactly right. Well, I mean, that goes into then really my next question here is about the biggest misconceptions now about using actuarial science in cybersecurity. Oh, I apply actuarial models. It solves all of my problems. I know my risks. I can figure them all out, and everything's going to be great. And it will look like demo land. I can make that happen with actuarial science. But let's go down some of those paths, Tyler.
I think there's a misconception for people who first come across this. They resonate with the idea that insurance can help, and so they think insurance and this actuarial modeling on its own can just solve the entire problem here. The data problem in cybersecurity can be completely fixed if we just turn it over to insurers. And the reality is that actuaries need data to do their job, right? So they're dependent on the claims driving their own modeling. And so it's tempting for cyber insurance to be seen as the one and only private sector solution to this information asymmetry market failure that's present in cybersecurity. But as powerful it is, it can't do that on its own, right? They need a reason to make the claims, right? And so sometimes this came about through the policymakers actually making the market, right? So data breach notification laws came along, and that is what prompted the creation of cyber insurance related to data breach, right? Other times it's the criminals, like in the ransomware discussion we had. But the thing to know is that there are very important aspects of cybersecurity, like OT environments, critical infrastructure security, that are entirely uninsurable right now for all practical purposes. Many, the companies that can get policies, they have very low caps that go beyond the kinds of potentially catastrophic scenarios that they're worried about. And so I think if we want to move forward, we have to think about how can we help enable the actuarial modeling to do its job, which is how can we feed it the data to actually enable it to provide the feedback.
Exactly. Daniel, any thoughts on your side with misconceptions?
I guess mine would be that traditionally there's been this view that the problem with cyber actuarial science is there's no data. And I think really it depends what you mean by data. So in terms of independent variables in a model, what we use to predict an outcome, I think there's actually more data than almost any other line of insurance, because you can ping from outside the network a network to understand what kinds of services are installed, what ports are exposed, et cetera, et cetera. Increasingly, insurers can use internal API integrations to get similar information inside. I think the challenge is you end up with a very overdetermined model because you only have a small number of breach outcomes. And I think that is the real core problem in cyber actuarial science, that we have all this data on terms of potential predictors, but we don't actually have enough cyber incidents. So in a way, it's pessimistic. In another way, it's good because we didn't suffer enough cyber incidents to have enough data.
Right. So we're just waiting for those to occur, and then then we can create the better model.
But I do think it goes back to Tyler's point about public reporting. Like, a huge amount of cyber incidents we just don't hear about because they're uninsured and there's no regulatory obligation to report.
Exactly. Now, Daniel, how do you see then the role of an actuary evolving in this space? Are we already on a path to delineate a capability here, or is there still more either education, alignment from an actuarial perspective to the cyber risk landscape, or we're on a path and we're moving towards that goal of integration and really an ability to utilize the information produced to communicate the risks that we've identified?
So I would say, like, an interesting perspective is you've done however many, over 100 podcasts, right?
Yeah. Yep.
And this is probably 160. And this is probably the first one on cyber actuarial science. And I think over time that could change as actuaries become, I guess, more central to a CISO's life. So you could imagine a world where the CISO's performance in terms of how they've matured the program actually materially changes the cyber insurance premium. If we were in that world, I imagine your CISO listeners would, want actuaries on this podcast every other week. I think the other perspective, I guess, is more of, like, that's, as kind of Tyler pointed out, the role of insurers in holding security practitioners to account. I think the other perspective is working together to communicate the need for cyber risk controls, which cyber risk controls work. So I think those two visions will progress slowly. I don't think next year it will be the case, but maybe in 10, 15 years' time, it's more towards the world I'm imagining.
Very nice. Very good. Tyler, any thoughts there?
Well, Daniel mostly stole my thunder, but I think I would go back to the potential to be a real contributor to answering this question about what works in cybersecurity, which cyber controls matter. Like, if we're ever going to get away from the RSA conference of the never-ending list of technologies that people just buy, I think actuarial modeling is going to be the key to unlocking that. And I think they've made a lot of steps in that direction. But I think that there's tighter integration between the insurance side and the technology side is ultimately what's going to be required to get to a point to where we can start to say something rational about which controls matter, getting down the number of controls that are ultimately required. The nice thing about the CIS controls is that it's like the shortest list of all, just about. I mean, maybe not the shortest, but you compare it to what folks in the DIB have to do with the CMMC version 2.0, triple digit controls for everybody. I mean, that I think is untenable. I think people will recognize it as untenable. And I think that because you have in the actuarial side an indifference to the particulars of the technology that's required, there's a real potential to simplify down to the core essentials of what actually matters.
Oh, 100%. 100%. So, Daniel, it sounds like we're signing up for an every other week podcast now on actuarial cyber risk. Fantastic. Sign me up. I will be there. I will host whatever you need.
Excellent.
Tyler, Daniel, again, I just want to say thank you so much. Again, I think this is important. Again, to Daniel's point, we've got to talk more about this. So if you want to, let's get you back on the podcast. And again, just really appreciate your thoughts and insights.
Anytime.
It was a great discussion. Thank you.
Absolutely. Thank you. And thank you to our audience. Any questions, comments, concerns? Do you like Daniel's idea? podcast@cisecurity.org. Remember to sign up in all the usual ways to the podcast on your preferred podcast provider. Catch us on YouTube at the CI Security. Make sure to like and subscribe. And with that, we'll talk to you soon.
Thank you for listening to the podcast today.
The thoughts and opinions expressed by our podcast guests are solely theirs and do not necessarily reflect those of CIS.
Tune in on Wednesdays for a new episode. And in the meantime, visit our website at cisecurity.org.
Together, we'll continue our efforts of creating confidence in the connected world.